is a PhD student at the UCL Institute for Environmental Design and Engineering. We're also joined together by two of Cave's supervisors, Nikki Zimmerman and Mike Davis. So welcome to you both. On the GLA side, we have colleagues joining us from the housing policy, demographics, economics, communities, skills, and strategy teams. I don't know about anybody else, but in my experience, this is a pretty big crowd for an academic presentation to the GLA, which I think indicates the level of interest both in this topic and in the systems dynamics approach. So Cave is going to present its findings, and then we'll have time for questions. If a question occurs to you during the presentation, please put it in the chat, unless it's an urgent issue of clarification, in which case, please put your hand up, and I'll moderate questions at the end. And now, over to you, Cave.
Thanks, James. Thank you very much for organizing this presentation. And good afternoon, everyone. Thank you all for being here. Just to check, am I the only one who can let people in the room in case people start joining later, or?
I will monitor that, Cave.
Yeah. Yeah, okay, great. Thanks, Nikki. So, yes, thanks again, James, for the introduction. Once again, my name is Cave Dianati. I'm currently finishing my PhD at UCL, and my supervisors are Nikki Zimmerman, Mike Davis, Joshua and Collins, and Nick Gallant. And yeah, at least Nikki and Mike are present here with us today. So I'm very excited to be here. This is actually the first time I'm presenting my PhD to an external audience. So it's exciting, perhaps also a little daunting, because I think collectively the people present in the audience today probably know pretty much everything there is to know about housing in London. So, but anyway, I'm going to give it a shot. I have quite a few slides, but I'm going to try and go through them as efficiently as I can so as to leave enough time for discussion. I really look forward to hearing your thoughts and comments at the end. So yeah, let's get right into it. So the title of my PhD is London's Housing Crisis, a System Dynamics Analysis of Long-Term Developments, 40 years into the past and 40 years into the future. So today I'm going to broadly follow the same structure as in my thesis, starting with a brief introduction and background. Then I'm going to present my reading of the literature on UK housing. Then I'll very briefly introduce my method and the system dynamics model, showing some validation tests, and followed by, most importantly, showing a few policy simulations and a couple of slides of conclusion. So, as you know, London's housing crisis has many different facets, and people mean different things when they refer to the housing crisis. So here at the outset, I'm going to start by clarifying the aspects that I have focused on in this piece of work. So first and foremost, there's, of course, the affordability aspect as shown in this graph of house price to earnings ratio, which is the most common indicator of affordability. As you see, during the past 20 or so years, the ratio has tripled in London, meaning that affordability has fallen by a factor of 3. And the rate of this decline in affordability has been much greater in London than the rest of England. Then there's the aspect of volatility and cyclicality, as shown here in this graph of detrended and normalized fluctuations in 3 of the key variables in the system: house prices, new mortgage lending, and new house building. And as you can see, there is clear cyclicality as well as a high degree of co-movement between these variables. And this level of instability is, of course, not good for the economy as a whole. And finally, there is the tenure aspect, and here the key trend is the peak and decline in owner occupation since around the beginning of the century, and along with that, the rapid rise in the privately rented sector, which is the most expensive and insecure form of tenure. So that should also be a cause for concern. So against this backdrop, the two main research questions that I've tried to tackle in this PhD have been the following. Firstly, what are the key underlying mechanisms responsible for the excessive growth and periodic oscillations in house prices, housing finance, and residential construction in London since 1980? And secondly, what are the implications of this underlying structure for the future of London's housing, both under business as usual and under a number of alternative policies? So there's a very rich literature around the housing situation in the UK and in London. Looking at the literature and also listening to the media, by far the most predominant narrative that you're going to hear is a narrative of shortage in supply, to the extent that for many people, the housing crisis is synonymous with a crisis of shortage in supply. And this narrative is usually accompanied by a graph that looks something like this. So this is new house building in the UK since 1950. And as you can see, there's been a sharp decline since the 1960s, mainly as a result of the slowdown and the cessation eventually of council house building. And in London, the data is only available since 1980, but the story is broadly similar, except that there has been an upward trend in private house building, but nowhere near the rapid rate of growth in house prices. And also, if you look at the average annual growth rate in population, in the number of jobs and the number of homes in London, and you compare it to the national average, you will see that both in terms of population and the number of jobs, London has been growing much faster than the national average. But in terms of the number of homes, the rate of growth has been exactly the same. So perhaps it's not surprising that you guys at the GLA have reported a backlog of housing need upwards of 450,000 units of housing in 2017. So this narrative of shortage in supply, this is not the only show in town, so to speak. The critics of this narrative cite different figures. For example, if you look at the growth in London's housing stock and compare it with the growth in number of households in London, you will see that both have grown by about 19%. And again, as reported by the GLA, there has almost always been a surplus of housing units over number of households. 150,000 units in 1991, and much more recently, still 70,000 units. So what exactly is going on? This competing narrative argues that the housing crisis does not have to do with a crisis of an absolute shortage in supply per se, but it has more to do with a crisis of inequality in the distribution of housing. And Danny Dorling from Oxford University, one of the most vocal proponents of this view, has written that the British have enough land and housing. It is just that increasingly most of it is owned by a smaller and smaller elite. And this links to the growing number of second homes and buy-to-let and buy-to-hold properties that restricts effective supply, which brings us to the issue of speculative investment demand. Again, if you look at the figures, Since the beginning of the century, there have been about 500,000 additional units of private housing, but during the same period, the number of owner-occupied dwellings has actually gone down by about 50,000 units, while the number of privately rented dwellings has gone up by about the sum of these two figures. So what this means is basically the PRS, the privately rented sector, has not only absorbed on aggregate all the expansion in private housing stock, but it's also bitten a substantial chunk of the owner-occupied share. And the literature links this to the deregulation of private rentals and better rights for landlords since the Housing Act of 1988 and the rise in rents, which has made investment in real estate more appealing to landlords ever since. And of course, the concern here is that those with existing housing wealth can leverage this housing wealth to get even more funds available so that they can expand their housing wealth and crowd out first-time buyers, which brings us to the issue of housing finance, which has been growing exponentially, really, since the deregulation of financial markets by the Thatcher administration in the 1980s that led to a flooding of credit into the housing market. If you look at the stock of outstanding mortgage debts as percentage of GDP, for example, it grew from 22% in 1980 to really mind-blowing over 80% in just after the crisis in 2008, and right now it stands at about 67%. And if you compare again household debt as percentage of disposable income in the UK against other advanced economies, the average of G7 countries, for example, you will see that the UK stands far above the G7 average. And this level of indebtedness is, of course, dangerous from a macroeconomic perspective. It's considered to have been a major driver of house price inflation, as well as instability in the housing and finance markets. And again, if you look at the business model of UK banks, you will see that the banks have, over the past few decades, they have shifted from lending to businesses to non-financial businesses, which used to constitute the lion's share of their lending. They have increasingly switched to lending to domestic mortgage, so mortgage loans, basically, which by now constitutes, has replaced lending to businesses as the main business of banks. And this, again, is, of course, considered perverse from a macroeconomic perspective, because lending to businesses is what brings about growth and employment in the real economy, while lending to existing property assets just serves to inflate the price of existing assets without contributing really anything much to the real economy. Okay, so with this quick review of the literature, the main method that I've used in my PhD is called system dynamics. System dynamics was invented about 60 years ago at MIT by Professor Jay Forrester. It is based on feedback control theory in electrical engineering, which is used in servo mechanisms and missile guidance, stuff like that. But since then, it has been applied to a really wide variety of problems, and it's a really powerful method for tackling persisting problems in complex economic, social, and/or environmental systems. And in system dynamics, we have a big focus on elements of dynamic complexity, which are feedback loops, accumulations, time delays, and non-linearities in systems. So based on my review of the housing literature, I developed this qualitative causal loop diagram, which highlights the key feedback loops in the system. Now I'm going to skip this slide before I cause any unnecessary trauma, but basically I converted some key parts of the qualitative causal loop diagram into a quantitative simulating system dynamics model that consists of 4 interconnected sectors: the house price sector and mortgage sector, there's a construction sector, and there's a tenure and rent sector. And this is a much more simplified causal loop diagram of the system dynamics model, which I'm going to walk you through right now. So here we have the key investment loop, where as house prices go up, the attractiveness of investing in housing as an investment asset also goes up, creating additional demand and pushing house prices further up. And this creates a bigger flow of new mortgage lending, both directly and also through the channel of increasing housing wealth, which is used as collateral. And this serves to create additional demand for housing and push house prices even further higher. And as this happens, more and more households are priced out of the buying market into the privately rented sector, which creates additional demand for renting, pushing up rents, and again, increasing the attractiveness of housing as an investment asset. So these 3 self-reinforcing mechanisms highlighted in purple are what I think the mechanisms responsible for exponential growth in house prices and housing credit over the past few decades. But then you also have balancing mechanisms that should serve to counteract this. For example, as new mortgages become available, this is considered to stimulate private house building, which can serve to bring down house prices and control house prices to some extent. And also, importantly, as more and more mortgages are issued, this accumulates in a stock of outstanding mortgage debt, which raises debt servicing ratio, which is basically the ratio of household income required to service housing debt. And there is extensive evidence that this will start to take its toll on the real economy. This will start over time to restrict household consumption, savings, investment, and all that. And again, over a long period of time, perhaps several years, this will feed back to impact the willingness and the ability of banks and financial institutions to issue further mortgage loans. And this can bring down a reversal. This can bring about a reversal of the trends that we've been seeing so far. So at a certain point in time, it can trigger all these reinforcing mechanisms in the opposite direction of growth. And it can lead to the bust period of the boom and bust cycles in housing and housing finance, the latest of which we saw in 2008. The key thing here is that these balancing mechanisms involve substantial delays shown by this sign here, which means that the stock of outstanding mortgage debt, for example, will continue growing far beyond its desired level, let's say, and this will create an overshoot and an eventual collapse in the system. So once you simulate the model, it manages to give a fairly good fit to historical data. The data is shown in black, and model simulation is the gray curve. So the model manages to capture the exponential growth and the characteristic oscillations, which are the key components that I was interested in here. And I'm not going to go into the detail of the error and the breakdown, but basically most of the error consists of what is called unequal covariance, which is unsystematic, you could call random error, which is fine, and there is a high degree of correlation. The same is true for other variables, new mortgage lending, for example, and mortgage balancing, mortgage balances outstanding, for which I have only a few recent data points, but note the really rapid exponential rise, especially in the 2000s in new mortgage lending here. Same is true for private construction starts and different types of dwelling stocks, private stock, local authority, and housing association stock, and total stock. The model manages to give a satisfactory fit to historical data. So what does the model tell us if we simulate it into the future? Well, what is shown is that we will continue to see a rise, an exponential rise in prices, in new mortgage advances, and the characteristic boom and bust cycles are bound to continue to happen under business as usual if current conditions continue to prevail. And in terms of tenure, we will have sort of continued slow downward trend in owner occupation and an upward trend in the PRS sector, privately rented sector. Then I've simulated a number of scenarios, policies, both on the supply side and on the demand side. On the supply side, I've simulated 3 scenarios. The first one is sort of a reproduction of the Affordable Homes Program as described in the draft London plan, which involves building 32,500 new units of affordable housing every year from 2020 until 2032 in the plan, but in the model, I've let this continue until the end of the simulation. Now, I should say this sounds insanely ambitious to me because this is over 10 times the current level of affordable house building. And even if you put together affordable and private house building, this is still 2.5 times the current rate of house building. So it is, I don't know how realistic it is, but in consulting with James, he suggested that it would still be useful to see the results of this. The second scenario on the supply side involves a relaxation of a gradual relaxation of planning restrictions, so an increase in the success rate of applications over time. And the third scenario involves the combination of the 2 policies. So in other words, we intervene in the system here via stimulating private construction and via directly contributing to the housing stock via affordable house building. So what the model shows is that the combined integrated scenario, of course, gives the best results in terms of growth in total housing stock. And in terms of private housing construction, the model shows a slight crowding out effect where we have the affordable house building. So private construction is going to be slightly lower than otherwise when we have the Affordable Homes Program. And then in terms of affordability, both for purchasing and for renting, again, the combined integrated scenario gives the best results. Both policies contribute, although in terms of rents, it's mostly the Affordable Homes Program that contributes to this, to the lower rents. In terms of changes in tenure, the Affordable Homes Program is expected to result in a shift towards the affordable tenure, obviously, which will come mostly out of the privately rented tenure share and to some extent out of the owner-occupied share. So in summary, the integrated supply side scenario is the most promising in expanding supply and slowing down the growth in house prices. And the Affordable Homes Program and the integrated one are expected to slow down the rise in the privately rented sector. And all scenarios, especially these 2 ones again, promise improvements in average housing costs. But the supply side scenarios do not serve to dampen the oscillations, and affordability still continues to decline, although at a much slower rate than business as usual. So on the demand side, I've simulated four scenarios. The first one, called capital gains tax, involves gradually extending the capital gains tax to primary residences, so treating primary residences as an investment asset. The second one involves gradually decreasing average loan-to-value ratios. And the third one, which I've called historically anchored valuation, in the UK, when issuing mortgages, banks base the mortgage on the current market price of the house. But in other countries with more stable housing and financial markets, such as Germany, for example, this is not the case. Banks are required to use a moving average of past housing prices when issuing mortgages. So in this scenario, I've implemented sort of this assumption. And finally, the integrated demand side scenario combines the three policies. These are the three intervention points in the system. It's probably easier to look at it in this simple schematic diagram. So the capital gains tax, here we have the investment loop and the housing finance loops that I talked about. The capital gains tax tries to not quite sever, but weaken the link between house prices and investment demand, and the two sort of macro-prudential policies, the lower loan-to-values and the historically anchored valuation, they serve to weaken the housing finance loop here on the right-hand side. So as you can see, the integrated demand side scenario, this one, the dashed curve, almost eliminates and flattens the curves in house prices and house price to income ratios. And there is, in the literature as well, there is growing evidence that macroprudential policies such as these ones serve to stabilize housing and financial markets. And in terms of mortgage advances, it stops the growth and volatility in mortgages. In terms of the number of mortgage advances, what is interesting is that if you take the average over the whole period, this integrated demand side scenario, perhaps contrary to what one would expect, it gives a higher average in terms of the number of mortgage advances. So what is happening here is that although we have a smaller pie of total lending, as in the left diagram, the size of each slice of the pie has shrunk so much because of lower prices and lower loan-to-value ratios that a larger number of households can benefit from these loans. So this is what could be called a counterintuitive insight. In summary, the integrated demand side scenario gives encouraging results, significantly slows down the growth in house prices and credit, and almost eliminates the oscillations. And as I said, counterintuitively, it can potentially widen access to more buyers. And considering that in the integrated demand side scenario, we also have the capital gains tax, these buyers are more likely to be first-time buyers rather than speculative investment buyers. But then again, affordability will still continue to decline, although at a much slower rate. And there is also the caveat that private residential construction could potentially be hurt because of the tighter financial regime. So finally, in the comprehensive scenario, I have combined all five interventions on both supply and demand sides. And this scenario, as shown by the long dashes here, promises a reversal of the trends of growth in house prices and decline in affordability. It shows that affordability can go back to levels seen around the beginning of the century under this ambitious portfolio of policies on both supply and demand sides. And also in terms of new mortgage advances, and it's the lowest. And in terms of number of new mortgage advances, it gives actually the highest results, so the best results in other towards, again, the best results in terms of growth in total housing stock, and it also promises a reversal of the continual rise in the share of the privately rented sector. So in summary, the business as usual scenario showed that under business as usual, we are likely to continue to see worsening affordability and recurring boom and bust cycles. The supply side scenarios serve to slow the decline in affordability, but cannot dampen the oscillations in the system. And demand side scenarios did curb both house price inflation and volatility. However, affordability is still deteriorated to some extent. And it was only the ambitious comprehensive scenario that managed to improve affordability and dampen oscillations, as well as improve housing costs. And perhaps most interestingly, the number of new mortgage advances exceeds all other scenarios in the comprehensive scenario, while the accumulation of debts and the debt servicing ratio stays the lowest. So in conclusion, in terms of housing policy, over the past few decades, the central imperative that has shaped housing policy has been a promotion of widespread home ownership, with a promise of social inclusion and economic security to go along with it. But right now, this appears to be an unfulfilled and false promise. And this neoliberal residential capitalism system no longer appears to be a sustainable path for the UK. And as Joshua and Collins has written in his book, in order to make a shift towards a more stable and sustainable housing finance system, deep systemic reforms are necessary. And the policy program presented here is a showcase for such reforms, and it implies at least a partial reversal of two of the major trends since 1980, which have to do with deregulation and privatization on the one hand, and a shift from supply side to demand side subsidies on the other hand. So, for instance, the Affordable Homes Program implies a shift back from demand side subsidies such as the housing benefit to supply side subsidies, and the demand side policies imply a stricter regulation. On the methodological side, due to the several limitations of the model, which I don't have time to go through today, in no way do I claim to have built the definitive model of London's housing. Rather, I'd like to present this as a successful proof of concept or a strong case in support of using such integrated feedback-centered dynamic simulation models, which offer a number of important advantages that I can go to later. But if I want to leave you with one takeaway message from this presentation, it is that I believe that the unit of analysis in housing policy and discourse must become feedback loops rather than individual factors. So in response to the question, why are we facing a housing crisis, what you hear most often is linear, perhaps simplistic explanations, such as we are not building homes fast enough, or it's because of a broken planning system. Rather than that, I argue that terminology such as the investment loop, the housing finance loops, and the debt burden loop that I introduced here must enter the scientific and political discourse, and perhaps over time enter public discourse as well, to improve our understanding of how things work in the housing system. So thank you very much for your attention, and I look forward to hearing your thoughts and comments.